I want to start with the tech sector, since we did see Apple in particular declining in the semiconductor space, seeing some very big declines. Is this a buying opportunity?
I don't think so. Tactically, we've actually shied away from the growth areas of the market, and that would be led by technology. We just saw such a big run up there last year, particularly as we came through the end of the year and into the beginning part of this year. And by contrast, when we look at the value-oriented sectors of the market, for financials, for example, there's just a better risk-reward trade-off there for us. So a couple months ago, we cut back our exposure to growth and, by definition, technology, and wouldn't chase it here. So it could settle down further, we think.
Kevin, let's talk about rates, because yesterday the lead story, I think, on the Bloomberg was talking about all these people concerned about flattening. And then, of course, you have a story like that, and then you get this one of the biggest steepening moves in a while, and sort of harkens back to early February. What's going on there? What's going to happen next? And B, what do you think explains today?
Yeah, it's going to all have to do with the economy, and our read on it lately has been actually somewhat better. As we came through January and February, March, we look at a wide variety of economic indicators, and we think the long end of the curve will key off that. And when we got to February, we saw some weakening. March, we saw some weakening, cut back on our equity exposure because we saw some weakening in the economy. But here, we're actually seeing a little bit of firming here. So I'm not at all surprised to see a little steepening, particularly after the flattening that we've seen in the last few weeks.
What we've also seen is a real ramp up in front-end rates. We've talked about LIBOR, OIS, we've talked about even up to the 2-year rate, and the implications of that for financing for companies in particular. And I know you've dug around and looked at the most indebted companies and the relative underperformance. Just what an increase in funding costs are we talking about for these companies? And do you expect that to continue to weigh on these stocks in particular?
Yeah, so companies that are financed at the short end, particularly with LIBOR, regardless of what the reason is for the increase in LIBOR recently, the reality is that it's going to increase funding costs. So we started to look at companies that may have a heavy amount of debt in their capital structure, and are also tied to LIBOR, and we saw that they've been underperforming, generally speaking, in the S&P. So that's something I think we have to be leery of, particularly this late in the cycle, as capacity has been drawn down, and we're seeing a little bit more tightness in the labor market. Output gap has disappeared, and some more signs of inflation. I think we just want to be a little bit careful there.